let's maybe paint a picture first. That could be helpful, right? How's M&A activity in the sector right now, maybe relative to how it was during the last cycle? And what does it tell you about the health of the market? Are you even following this? I don't even know if you follow this.
Yeah, I mean, we pay attention to it. It's not a very lively place currently in terms of M&A, and part of the reason is just there's so few companies in the space. M&A was definitely more active in the previous bull market because we had a huge rush of new companies come in. You know, it started out with literally less than 10 companies publicly traded at the 2003 into 2004 once things started moving. But it went from less than a dozen companies to 400 pushing 500 companies over the course of about 5 years. So it was an absolute all-out rush into the space, and we aren't seeing that yet. I mean, we're seeing spin-offs. We saw a company called Consolidated Uranium spin off one of their assets, turning it into Labrador Uranium. We see, one or two, maybe three companies on the ASX pop up with a little asset here, a little asset there. So we've gone from about 50, high 50s to about high 60s. I think we've added about 10 companies to the space over the past 2 years. So it's something, but it still hasn't been an all-out rush. It's just still a very, very small space in terms of not only overall market capitalization, but the sheer number of companies.
Does M&A necessarily have to happen very, very early on in the cycle to ensure a more stable or a longer term bull market or a spikier market? Does it really have to happen at the beginning of a market?
At the beginning of this market, what we saw was less of M&A. And I think that part of the reason why was that the bear market was so brutal and so drawn out that it washed out almost every single company. To go from 400 something companies down to at some point, what did we have? Maybe 45 companies. Pretty much the survivors are what was left. And out of those survivors, you had a number of companies that were getting pretty aggressive in terms of not necessarily M&A, but actually seeking out projects. So looking at properties, staking in the Athabasca Basin, you saw companies scoop up projects relatively cheaply, buying them from other companies. So not necessarily taking over companies, but actually just acquiring their projects. And that definitely happened a bit more, I would say, the previous couple of years. So 2019 into 2020, even 2018, for those that were kind of aggressive and more positive on the mid to long-term outlook for the sector, were scooping up projects left and right. I think that one thing that does limit the M&A, though, is that there's so many companies in this space that either have projects that will never come online, and the prospective acquirers know that. And to apply a valuation to a company, there's companies that are worth $50 to $100 million US that have just absolutely garbage assets that are never going to get into production. And those companies are not necessarily attractive to acquirers, right? So there's a very limited number of players in this space that have quality assets, that have quality jurisdictions, that are still at attractive enough valuations for an acquiring company to take them over. So you have a bunch of companies in that $150 to $400 million market cap range, like somewhere in that range. And the prospective companies for acquiring those projects already have their own projects they're knee deep in, if they had the sufficient valuation and value to their shares or cash to go ahead and take over a smaller company. So it's not something that we're really all that concerned about. I mean, we watch it out of interest, and, there's a number of companies that we feel could still seek out M&A, and that's something to look out for. One of the most recent acquisitions was the Uranium One assets by Uranium Energy Corporation. And that, I think, was a well done acquisition. I think that the value that they paid for those assets was very well done. And UEC was in a place where they had cash, and they had sufficient, I don't know, I think they did an all cash deal. They might've done cash and shares. I don't remember exactly, but that was one of those acquisitions that caught my eye. I thought it was well done.
Do you think we can do a complete, perfectly fine cycle without M&A? Like, in this whole cycle exist without any M&A whatsoever? What would that look like?
Yeah, I honestly think so, because I when I think about M&A, let's say in the gold space, you see typically the projects that get taken out are very highly prospective development projects, an asset that has potentially millions of ounces, and they could get into production over the course of a number of years with a certain amount of capex. And the acquirer knows this. They know that they are paying for something that is going to be producing cash in the next few years, right? I mean, that's kind of the typical takeover in the precious metal space. In uranium space, there's just, I mean, very, very few of these projects will be producing in the next few years. Now, if we do have kind of a uranium super cycle that goes on for 5+ years, then there's far more projects that have the potential to produce, right? But that's not something that, honestly, the way this sector typically works is the production of existing producers or near-term developers, let's say, can't respond very quickly to the price spikes. And so it's just, this is how uranium has worked every single cycle in the past. You see massive spikes in the price, and then they come back down, and then you see a long bear market. And I'm not saying that is going to happen for sure again, because we have such a strong growth projection for nuclear that we could see a longer term bull market. But that also might be a reason why you don't see more M&A, is because the companies that they would be acquirers don't necessarily believe that 10 years from now, 8 years from now, the commodity will be at a price. Not necessarily that nuclear won't be still growing, but if we spike and crash, which is always possible in this sector, what's the point of overpaying for an asset that's never going to bring you any cash flow? Other than maybe building on those assets gives you more acumen, let's say, and more resonance in the market, more recognition by the market. So, you've seen companies. Gosh, let me think of some examples here. I mean, you see, I'm spacing out and thinking of a perfect example, but and I also kind of don't want to talk about these companies specifically because of whether or not we own them, and out of respect for our newsletter. But you'll see companies acquire assets that may or may not come into production, but it leads to a press release. It leads to the market recognizing that, oh, these guys are still aggressive and they're still going after it. That's cool. So, and the market recognizes that. So to that extent, we could see some more M&A simply for building up pounds in the ground for the sake of the market recognizing that.
What you said back there, what's the point of acquiring an asset if it's not going to bring you any cash flow? That's a good point. And it actually reminds me, as a quick clarification as to why we're even talking about this, is because one of the ways to make money as a shareholder of any company, I guess, natural resources, is for the company to be sold to another company, or for it to maybe sell some of its assets, or, to get into production, start cash flowing, paying a dividend. But so I watched a Smith Weekly video on M&A. That's what actually, that's why I had a few questions to write down. But so I started looking into companies that have interesting assets, I should say, that might be prime targets for takeover. But I also found some companies with projects from the last uranium cycle that was their whole strategy, that they were hoping to sell, but they never did. So I was just wondering, what do you think about those companies? Should we maybe, what do you call it, adhere? Should we stick lower valuations to those companies just because they weren't able to sell their assets last time?
That's a great question. That's a really interesting question. I actually don't know how to answer that. I would say not necessarily. And part of the reason for that is that the price did spike so quickly that we did see some sales of, some massive buyouts. We saw Energy Metals sell to Uranium One for, what was it, 1.8 billion. That was literally, I mean, they top ticked that market absolutely perfectly. I mean, I think it was within a month that the market turned to the downside after that sale. So that was a perfectly timed sale. So a lot of that has to do with luck, but of course that company built up their assets. They had the largest landholding in the United States at the time. And so that was obviously attractive to Uranium One for that sale. Um, there's a bunch of companies in the Athabasca that have assets that on paper look fantastic, but you have to actually consider if they are prime takeout targets, you have to ask who would take them out. And then you think of those three companies and you consider, well, what are they doing now and what do they have currently and what is the likelihood they're going to go after those assets? Do they even have the time or the money to do that? Does it make sense considering the assets they're already sitting on? What else are they working on, et cetera, et cetera? So I think that there's very few companies in the space that would be attractive as an investment with the goal of them being taken out as your investment thesis. And of course, people, I know a number of investors, or maybe I should say traders in the gold and silver space, who they specialize in takeout targets. So they will look for specific jurisdictions, specific assets, specific management teams, and the goal is for that company to get taken out. That's why they buy it. Mm-hmm. In uranium, I think that there's only a few. I think that has mainly to do with jurisdiction and the type of mines. Like I think there's some Namibian plays that are probably more prime for takeout. Higher cost projects, jurisdiction that's friendly to, let's say the Chinese, taking out projects, which they have done in the past with Rossing. They've got a stake in Paladin's Langer Heinrich, the Husab mine, et cetera, et cetera. So, some of the Athabasca companies with assets that you think would be prime for takeout, I'm not so sure. I think that there's speculation on that, but I don't know that it's necessarily a great reason to buy a company in the uranium space.
Okay, that's an interesting point, and that's the question is not easy. I have no idea how to answer it either. And whenever I'm talking to companies who, I'd ask him, that's one of the first things that I'd ask, like, what do you, how are you going to make me money on this? You're going to pay me a dividend? You're going to be bought out? And if they say that there is a possibility to get bought out, most of the times I'd ask him, hypothetically, somebody comes up with, $1 billion. Do you take it? Do you not take it? How much do you want for it? And then I instantly started thinking, like, what company is going to pay that money later down the cycle? Like if they say, no, I'm not going to sell for $1 billion, then I'm like, well, okay, this is going to get weird. Possibly the other companies are going to have to 10x to be able to raise money, not to dilute the shareholders by too much to buy your assets. So it sort of gets impossible. And that's how, I crossed that takeover target off my list, sort of. But I also think it depends if I'm thinking about it, and I'm going to be thinking out loud. So I might say some stupid stuff, but it also depends on whether, when we're talking about, should we discount the older the projects that were already around last time and they didn't get bought up? I think it depends on whether there has been any work done on the project. Is there more money that went into the ground to get the project, to get to know the project better, so the company can maybe market it better, make it more interesting for a major, for a larger company, or if maybe the management team has changed, because for all we know, I'm not a geologist and I don't really know projects well, but if the project is now in more capable, maybe it was a good project. That's what I'm trying to say. Maybe it was a good project, but it was not in the right people's hands, so they couldn't really sell it. Then yes, it might be worth revaluing, basically. That's sort of my working thoughts on it. And
that makes sense.
Yeah. Now, by the way, Justin, I know that you, as you mentioned, out of respect for your paying members, you don't like talking about specific companies, and I too respect that. But it sounds to me like you haven't really added any specific companies because of them having a higher chance of transaction. Is that like most of the companies that you've added? Is that because you're hoping them to pay a dividend, or like how do you plan on making money on those on the companies that you add to the portfolio?
I mean, I think that the main thesis for making money on any company in the uranium space just has to do with expected share price appreciation due to, the flow of funds into the space. Okay. There's obviously individual reasons for owning individual companies. I know you were asking about valuations before and performance and all that. And, there's one company that we do not own, that I won't name, that there's definitely a lot of bullish people on this company. They own a smattering of assets, and I mean, this company has underperformed Cameco on a 3 or 4 year time frame as a junior.
Yeah.
And so during the same time frame, this company has done about, gosh, I think it's maybe doubled, and maybe it's close to a triple. I mean, which is great, right? I mean, I shouldn't be, I shouldn't be, you know, talking negatively about those types of returns, but there have been other juniors that started off at the same valuation as they did at the same time frame that have gone up 10 or 20x or more. And so, and this is a company, I mean, this company is prime for kind of what I was just saying. Like, they've got these assets. Everybody's like, they're going to spin them out. They're going to get taken out. And it's just like, they're just sitting on these assets waiting for that to happen.
I don't know if they, you know, I think I know who you're talking about. And I spoke to their CEO. I'm not sure that they exactly know what they want to do with it, but you're right. I think I know what you're getting at.
And I'm not trying to be specifically critical of the company. I'm just kind of pointing out that regardless of the number of companies in the space, the valuations that the companies were at or are at now, there's vastly different shareholder returns. So to be able to pointedly be positioned in companies that can outperform, obviously, is what we're seeking to do with the newsletter. And so to answer your question a little bit more thoroughly, we don't necessarily look for M&A. We do have a couple of positions where we expect that M&A is likely in terms of the company being taken out, and that has to do with their asset and jurisdiction and other players in that jurisdiction. So that's not necessarily the reason that we bought the company, but it is a potential upside. Okay. So yeah, there's a number of things that we look at, and that's one of them.
Okay. You know, when you mentioned the assets, because the company that you're talking about, that their assets are not awful. They're not, I mean, they have a lot of them too. So they're not, the assets are not really bad. And that actually might be an interesting discussion as well. Like, do you think that the asset is the only thing that matters during an M&A cycle? Or like the people running the bigger companies, are they only looking at the asset, or do they have to know the people who run those assets? Like, does it maybe depend on what type of CEO runs it? How do you think they look at that? I know you've spoken to some of the bigger companies. Do you ever talk about that?
Yeah, I mean, the bigger companies usually are pretty tight-lipped about potential acquisitions. The companies that have made acquisitions, let's say in the last 12 to 18 months, the projects that they've taken out, or the companies that they've taken out, are development potential. So, for example, UEC buying Uranium One assets. They've got ISR processing facilities in Wyoming and a bunch of ISR assets. Like, those can come online in Wyoming in the next couple of years. You know, they can easily bring that into production. The other acquisition, Encore took out Azarga. Azarga's all same thing. They've got fully permitted mine in South Dakota. It's got a little bit of hair on it, but it's the best ISR project in the country. And then they got other assets in Wyoming also. So they knew that they could likely bring those projects toward production during the cycle. That's why they targeted those assets at this time. I think that now also maybe why there hasn't been more M&A in the past is because you still were at prices that, even, you know, a year or two into a quote unquote bull market for the commodity. So the commodity bottomed in 2016. You know, it's been moving up for 6 years, almost 5.5 years, which is crazy. Because the equities bottomed, you know, 2 years ago. But even now, there's a lot of assets that are difficult to get into production at $50 uranium. And so even if you were interested in M&A a year and a half ago at $30 uranium, what's the point, unless you really believed that the price would rise along a timeline that a project could come into production? And that's a speculation that not very many people in this space, even with the CEOs across the space, there's very few that I've spoken to that have that type of confidence in this market to say that we can go after this and the price is likely to be around here or moving in that direction by the time we could do this. Therefore, we're going after it. So, you know, I mean, a company, again, I'm not going to say whether or not we own this company. A company like Deep Yellow, they've got Namibian development project that's, you know, it's kind of a classic Namibian project. It's kind of like low grade sand that's not too far from the surface, open pittable. They've drilled 1 billion holes in the desert and they have it proven out to a decent sized asset. And, you know, we were hearing forever that they were likely going to take something else out. They were going to go after some kind of acquisition. We thought they were going to go after Forcis because Forcis has sits on it's actually the furthest along in terms of pre-development of any of the Namibian development companies. Their asset, forgetting the name of the top of my head, but they never did go after that. And then just last year, they made kind of like this loose bid for Vimy, just kind of like threw out this number and just like threw it on their desk. And Vimy was like, yeah, no, I don't think so. So that's just one of those companies. Like, I mean, in my opinion, he kind of waited too long because you also have to look at relative valuations. So it's not that easy to take out a company that thinks that their assets are really great. So the company that we're probably both thinking of in the Athabasca, they're not likely to give away those projects. You know, so who's going to buy them at that valuation? I mean, who literally could be buying out a company like that? Cameco, Orano. I mean, who else is in Canada that's of size that has the cash or the valuation to go after a mid-cap development company with good assets, but you have to compare that to what they already have and what they have in their own development pipelines. So I think the takeout case for this company or a number of other companies in the Athabasca is not great. That doesn't mean the stock won't go up, or they could seek out their own developments, or, you know, who knows what can happen. But
yeah, I guess this also helps you sort of see the difference between what companies can be speculations and what companies are you know, investments. What companies are you buying? What stocks of companies are you really buying with the sole idea of hoping to find somebody out there to sell it at a higher price? And what companies do you think are really close to production and can do something this cycle? And obviously, I guess mathematically, the further out it is, the lower the probability is of the company doing something within this cycle. So if they have plans to starting production by 2045, I mean, it could, you know, the cycle could go as that. I don't know. I guess it could, but everything could happen. But the probability is lower than a company that will go into production by, let's say, 2024 or something like in 2 years, right? So that sort of helps you see between those different companies. But that's an interesting discussion on M&A, Justin. But I guess let's move away from that topic because I know you don't have too long today any left. Because I also wanted to talk to you about geopolitics because you had an episode.